What if I told you the two most powerful economies in the world just auctioned off market access, tariffs, and billions in investment to the highest bidder? Not a blockchain startup, not a Silicon Valley darling, but the United States and Japan are rewriting the global trade playbook with a $550 billion investment for tariff cut pact that President Trump hailed as the largest trade deal in history. This landmark agreement slashes U.S. auto tariffs from 27.5% to 15%, while unlocking Japanese pledges to pour capital into American factories and supply chains. It is being touted as a seismic shift in alliance economics that could reshape global manufacturing hubs overnight. Before we dive in, take a breath and pour that coffee. Because today's story isn't about housing markets. It's about strategic leverage and alliance economics under an America First doctrine. We'll unpack the logic behind a $550 billion Japanese-backed investment pledge and deep auto tariff cuts. And we'll examine what this means for exporters, supply chains, and geopolitical power. Let's begin. In 2018, President Trump shattered the assumption that allies would enjoy immunity by slapping 25% steel and aluminum levies on close partners. Japan briefly secured exemptions, but quickly learned there are no free passes under America First. That rupture fractured decades of WTO-driven multilateral diplomacy and set the stage for today's deal. We'll show how this bilateral model has become Trump's signature tactic in trade. From the United Kingdom to the EU and now Japan, every agreement follows the same playbook. And we'll reveal who stands to gain and who could lose in this new era of strategic leverage. The U.S.-Japan Pact delivers up to $550 billion in government-backed loans and guarantees to fortify American supply chains in critical sectors. It cuts auto tariffs from 27.5% to 15%, offering immediate relief to Japanese automakers. And it pries open Japan's tightly guarded agriculture market, boosting U.S. rice imports by up to 75% under existing duty-free quotas. Yet it conspicuously excludes steel, aluminum, and defense spending commitments, leaving major strategic sectors untouched. This isn't mere tinkering. It's a strategic strike aimed at reshaping balance of payments and alliance economics. If this sounds familiar, it should. Every empire, when pressed, monetizes its crown jewels. Thatcher sold off British gas and telecom. Russia auctioned stakes in Rosneft to fund its transition. China listed state champions in Hong Kong via H shares to attract foreign capital. Now, under America First, Washington is using trade pacts as its new bargaining chips. This is classic leverage, coercion thinly masquerading as cooperation. This isn't innovation, it's realpolitik dressed in opportunity. The Nikkei Auto Index jumped nearly 4% as Toyota and Honda shares surged on the tariff cut news. Japan's broader market added over $1.4 trillion in capitalization amid a rally in export-oriented sectors. Wall Street futures climbed, signaling global markets foresaw more deals ahead of the August 1st deadline. For many traders, this was Wall Street's new Super Bowl, with arbitrage and asset managers licking their chops. So why now? The answer lies in the 2025 political calculus. Congressional gridlock, re-election pressure, and a desire to recast federal assets without new taxes. Japan, America's top Asian ally with deep supply chain ties, made the perfect test case. Rapid top-down diplomacy let Trump claim a headline win while sidestepping Congress and stiff-arming recalcitrant partners. And with an August 1st tariff deadline looming, the timing was anything but accidental. But here's the twist most observers miss. This pact doesn't just tweak duties. It rewires global production and risk matrices. By replacing WTO multilateral rules with bespoke bilateral terms, it forces exporters to reprice risk, and hedge currency exposure more aggressively. Expect Japanese manufacturers to accelerate US-based capacity expansions to avoid sudden duty hikes. American firms, meanwhile, will hunt for yen hedge financing and diversify sourcing away from China and Europe. Critical inputs in semiconductors, pharmaceuticals, and rare earth elements now come with heightened geopolitical premiums. So who wins? Japanese government-affiliated lenders stand to collect fees on up to $550 billion in secured loans and guarantees. But analysts note only 1 or 2% of that sum will likely flow into actual capital projects. Hedge funds and trade financiers who bet on Trump's brinkmanship emerge vindicated, riding a surge in volatility trades. And supply chain consultants have already booked a backlog of high-margin mandates to navigate the new carve-outs. Private banking desks will book windfall fees structuring the $550 billion fund, with the U.S. retaining 90% of profits. That 90-10 profit split underscores how Washington engineered a revenue stream while limiting Tokyo's upside. For advisory firms, navigating loan guarantees, equity tranches, and tariff carve-outs will command premium rates. And for rating agencies, assessing the deal's credit structures is a goldmine amid rising geopolitical risk. But the real game begins next. South Korea is racing to clinch its own pact before the August 1st deadline. Minister-level talks in Seoul will cover tariffs, investment pledges, and potential technology transfer safeguards. Failure to strike a deal could see Korean goods face punitive rates well above 25%. Meanwhile, European Union negotiators are scrambling to lock in symmetrical terms to avoid their own trade penalties. This bilateral blitz is replacing multilateral forums as the venue for high-stakes trade drama. If you're watching for ripple effects, here's where to look. Exporters in electronics, pharmaceuticals, and autos must recalibrate transfer pricing and hedging strategies. Companies like Sony and Panasonic may shift North American production to neutralize sudden tariff shifts. Automotive suppliers in Michigan and Ohio could see orders swing if Japanese imports regain price advantages. And agricultural exporters will need to navigate complex quota-based rice and dairy access under WTO rules. Consultants warn that small and medium-sized exporters could be squeezed by compliance costs and currency volatility. Regional banks could see surging industrial lending demand as companies realign factories, but also face heightened credit risk if trade slows. Bond funds that banked on stable yield curves during tariff skirmishes might see mortgage-backed security spreads widen if inflation flares. Municipal bond managers could pivot as local projects benefit from Japanese infrastructure investments in the U.S. Currency traders will closely watch Japanese and dollar swap rates for carry trade reversals, and safe haven assets like gold may rally on renewed geopolitical premiums and supply chain jitters. Here's an angle you won't see on CNBC. U.S.-Japan bond flows have functioned as a cloaked sovereign borrowing channel. Japan parked over $500 billion in U.S. Treasuries and agency MBS in recent quarters. Shrink that pipeline without clear backstops, and foreign demand for U.S. debt could waver. That's how the dollar index begins to slip when bond yields need pricey inducements. Global funds may rotate into euro-denominated assets, gold, or emerging market credit to sidestep rising U.S. rates. Global funds are already circling for yield in strategic commodity and currency plays. Rare earth element exporters in Africa and Australia could benefit as supply chain hubs shift. Emerging market debt funds see opportunities as carry trade dynamics realign. Meanwhile, yield-seeking mortgage REITs like NLY and AGNC may thrive on wider spreads. But fund managers caution, volatility spikes can swiftly torch carry trades when risk premiums retrace. So the question becomes, does a deal-driven trade order boost American leverage or quietly erode the dollar's post-war security? When foreign holders sell MBS, they liquidate dollars, and that's how the dollar index slides. A weakened dollar would ripple through commodity prices, corporate earnings, and global debt servicing. For U.S. policymakers, privatizing leverage may solve short-term ledger gaps, but at a long-term currency cost. Here's the hard truth. Trade pacts don't build factories. They don't fix choke points or guarantee wage gains. They simply redefine where profits and risks reside, shifting both onto private sector balance sheets. And they place political pressure on allies to bend national interests to the U.S. economic agenda. For most workers, the cost of living doesn't budge. It just gets repackaged in higher import prices. For the average exporter, tariff inflection points force small firms to hire compliance consultants for quota management. They must negotiate complex MOUs that rarely align with domestic capacity or cash flow. This is policy theater, less about ground-level improvements, more about the illusion of action. Meanwhile, homegrown manufacturers face capital allocation dilemmas, expand locally or chase subsidies abroad. Small business owners could see margins erode as duties reset and geopolitical risks surge. Rome taxed its citizens, Britain privatized rail, and now America forces allies to water in their own wine. This bilateral blitz will be packaged as modernization, but underneath lies something older, liquidating strategic leverage for short-term gain. It's a quiet surrender of state power to capital interests disguised as cooperation, and it offers a roadmap for emerging economies on how to win concessions at a steep price. But if you're sharp, you'll see the patterns and position yourself ahead of the curve. But here's your window. Watch Japanese corporate bond yields for clues on capital flow shifts. Monitor South Korea's trade package negotiations for early signals of broader carve-outs. Track Chinese rare earth export controls as U.S.-China talks shift to Stockholm. And align your equity and fixed income allocations with sectors best placed to thrive under higher premiums. If you found this breakdown illuminating, share it with someone who still thinks trade policy is technobabble. Drop a comment. Will this deal cement American influence or expose its diplomatic limits? And if you want more no BS breakdowns, subscribe and hit the bell. Because when trade rules change, opportunities flood in for those who saw it coming. And as always, context is king. Deep dives beat sound bites every time. History rhymes, power rebrands, stay inquisitive.